The next adjusting journal entry is because we just haven't recorded a transaction yet. Usually in this first example, it's when we've used up some goods and services, but we haven't recorded it. And so payroll is almost always an example in all the problems. So let's say our normal weekly payroll, we have people work 5 days a week, so it's $15,000. And we always pay people on Friday afternoon for the work they did that week. So let's say that March 31st is a Tuesday. We haven't recorded the payroll yet because we're going to pay them on Friday, but the people worked for 2 days. So 2 days of that 15,000 really belongs in this year, and the other 3 days belong in the next year. So we just have to make an adjusting journal entry to recognize that expense. Here, we're not going to do anything till 3/31. And at the end of the month, we say, okay, we really have some salaries expense. And you can, in some problems, they call it wages expense. This depends on if you have people who are salaried or hourly. We owe those people. So if we owe those people, it's a payable. So the amount is 15,000 divided by 5 is 3,000 per day, and it's 2 days. So we owe them $6,000 for those 2 days. So that's our adjusting journal entry. And this one kind of happens in the opposite order of the one we did before, because then on April 3rd, which is the Friday, that's the date that I'm really going to pay them. So that would be 4/3. So when I actually pay them, pay cash of 15,000. But looking up here, the first thing I got to get rid of is this salaries payable for the amount that's in there, because I already expensed that, and the rest of it needs to get expensed in this period. So 3 times 3 is 9, and that totals out to 15. So now I've got 6,000, 2 days of pay last month. I've got 3 days of pay expensed in this month, and I still paid people the right amount, and everything seems to balance. The same thing can happen with revenue if you're on kind of the other side of a transaction. An easy one to kind of see here relates to interest. So let's say that we're a furniture store. So we're Bob's Discount Furniture. And a customer buys $60,000 worth of furniture from us. Somebody got a really big commission on that one. The furniture costs Bob's Discount Furniture $40,000 to buy. On April 1st, the customer will pay $60,000 and $300 in interest. It's kind of a pricey interest rate, but careful what you sign when you go buy that furniture and put it on account. Remember that when we sell inventory, it takes 2 entries. So the first thing I'm going to get, I'm going to call that a note receivable. Got to make sure you're on the right side of the transaction. So I'm Bob's Discount Furniture. So there's a note receivable for $60,000. That's my revenue. I'm going to call it sales. Revenue would be okay too, for $60,000. I also have to say that that inventory walked out the store with them. So my inventory goes down for the cost. Don't ever make it the same amount, otherwise you're never making any money. And that's that special account that we have for the cost of the goods sold. So I made $20,000 on that sale, and that sale gets recognized because of our revenue recognition principle in the year the person walks out with furniture. So they did take the furniture. We don't care that they didn't give us cash. We want revenue in the period the sale is made. So then on March 31st, my sales are great. It's this interest that is an issue. And they're going to owe us, and read the problems because they're all a little different. But here I'm just saying on April 1st, they're going to pay us that interest. On March 30th, they owe us the interest, but they haven't paid us yet. So going back to the interest. So they owe us the interest. So it's like an account receivable, but we're going to call it interest receivable because we always care about what happens with financing and how that's different from what happens with our regular sales. And it's going to be interest revenue. And I think I'll try to spell out receivable. I before E. It's clear that one's receivable and one's revenue. When you write a problem, make sure it's really clear which one's which. So just don't put interest R or even RE. They're going to owe us April 1st, so we don't worry about that extra little day there. So they basically, on midnight on the 31st, they owe us $300. So that's what we want to see on our financials. So when they actually pay off their loan, we can do this in a couple steps. But on 4/1, they're going to pay the interest and the principal. So I'm going to do this upside down again. I have to get their note receivable. Has to go away. That's $60,000. Their interest receivable has to go away. Cash that I'm going to get is $60,300. So this has to go away. That has to go away. And you get the cash for the total. So similar kind of interest, whether it's interest receivable or interest payable, salaries, utilities. If you think about utilities, I use up my electric and then they send me the bill for what I used in the past month. And all those bills that come after usage. So in my case, when I get my bill for my trash and my sewer, that comes after my usage, any of those other sorts of things. If you, again, have construction done, and then after they're finished, they bill you for the kitchen remodel, you might have some adjustments to do then.